Live from Hong Kong, I'm Yvonne Mann. This is Insight, where we dive deeper into stories that matter with crucial context and sharp analysis. And taking a look at markets here right now, Asian stocks are steadying their rally to a fresh record as a rebound in tech gathers pace. Chinese regulators, meanwhile, advising banks to cut exposure to U.S. debt over concentration risk and volatility. We'll chart a course through these choppy markets with SEB's Eugenia Victorino. And a triumphant Japanese Prime Minister Sanae Takaichi promising to build trust with markets after election landslide, but tensions over Taiwan prompt a stern warning from Beijing. Alphabet goes on a $20 billion bond spree to fund its massive AI spending plans. We'll get insights on the AI capex explosion with respected tech analyst Rob Enderle. And FTSE Russell says it's postponing a March stock index review of Indonesia as regulators promise reform. JP Morgan Asset Management's ASEAN equity team head Pauline Ng joins us to look at whether they can deliver. Welcome to Insight, and take a look at the state of play when it comes to markets here right now. We are at those records here when it comes to Asian stocks. So this tech rally once again continues on. U.S. futures are slightly on the negative side, but it really has been that sort of drop in the dollar that has been provided to be a proven kind of tailwind when it comes to risk assets here this morning. Yet pair that with the scoop that we had on China really telling banks to reconsider their U.S. Holdings of treasuries, I should say. That certainly is maybe adding to a little bit more fuel into the renminbi, and certainly maybe adding some more weakness to dollar assets here today. So that's certainly one thing to tell you now. At 690 levels for offshore, that's 2-year highs for the currency if you look at the offshore and onshore rate. Japanese yen continues to be stronger here after that election landslide win for Takaichi there. So we're at 155 levels. So that's really kind of weighing on the greenback, those two stories here this morning. We're still tracking when it comes to Bitcoin, actually getting back to 70,000 has certainly been a milestone there. We're slightly lower in the Asia session here, but Brent, we're still focusing on what goes on in Iran, the metal space and the like here. Now that gold seems to be back above that 5,000 level. Jakarta is interesting. We're seeing actually gains of 1% there. This is despite what we heard from FTSE talking about how they are kind of pausing or postponing that March stock index review for the market there, given just the reforms that we've seen after, of course, MSCI's warning there. The stocks actually are doing better there. We're up about 1% in Jakarta here. Futures in India actually are flat this morning. So certainly that's one to watch. Let's get to our scoop here and really what the longer term implications are of what we've learned, that Chinese regulators have advised financial institutions to rein in their holdings of U.S. Treasuries, citing concerns over concentration risks and market volatility. Let's bring in our China correspondent, Min Lo, on the rationale behind this move and really the scale of how much they're willing to at least reduce their exposure now.
Yeah, we're not too clear on the target of their scale to reduce their exposure, but we know that Chinese regulators have been quietly and verbally asking some of the top banks to reduce their purchases or trim their exposures to U.S. Treasuries, which suggests that perhaps they have some concern over concentration risks, especially with the dollar sliding. We've seen that particularly in January, especially as Donald Trump said he was comfortable with a weaker dollar, and of course mounting fiscal risks as well, the trajectory of the Fed rate cuts, perhaps a tactical move as well, an expectation that Kevin Walsh could be a little bit more hawkish going forward as well. So, but bear in mind, this is not a new thing for China. They have been gradually trimming their holdings of U.S. Treasury for over a decade now, and we haven't seen, the sort of bear market come through. So some analysts are saying maybe don't read too much into this, although others are saying we did see the dollar slide, so maybe this could be something that could gather steam because nobody wants to be left holding the bag.
Yeah, and sort of reinforces this kind of bigger story about diversification away from the dollar in some ways. In terms of the banks, Chinese banks, what impact could this have?
Yeah, I mean, if you look at China's holdings of U.S. Treasury, it's already at a 2008 low. So if you look at the top 4 banks, they have about $370 billion in U.S. dollar denominated bonds. That's about 5% or so of their bond holdings, or 1.5% of their total assets. So not a whole lot. So the de-risking probably won't have a huge impact on the banks. But I think Bloomberg Economics have a very interesting take. They forecast that China will continue to reduce reduce their holdings of US dollar assets by 60% by 2020, by 2050 compared to 2024. So this is more of a longer strategic view, especially given the global shifts we are seeing in terms of the US share of global GDP, for example, the US dollar role in cross-border transactions, especially for China, and particularly after the tariff war when we had seen Chinese exports to the US plunge by 20% on year last year.
Okay, Min, thank you. Our China correspondent, Min Lo, highlighting that scoop for us as well. Let's get more on this adjustment to US Treasury exposure and bring in Eugenia Victorino, head of Asia strategy at SEB. Eugenia, it's great to have you. The timing of this story, I think, is quite interesting. Why do you think China might be even considering reducing their exposure to U.S. Treasuries at a time when U.S.-China relations are actually quite stable right now, relatively speaking?
Thank you very much, Yvonne, for having me. But as Min has already said, this is nothing new. We've been seeing the share of China's ownership in U.S. Treasuries going down for a number of years. So I would say this has been a structural strategy of the Chinese authorities. And even then, if you look at Chinese holdings of U.S. Treasuries at this point, it's only 2% of the foreign-owned. So it's unlikely to be the real driver of the decline in the dollar. I would say that the market reaction yesterday on the news was because there is no new driver for the dollar. So they're trying to hang on to a new driver just to continue to sell the dollar at this point.
Okay, so maybe just lack of catalyst is magnifying some of these moves. But do you think that there's, in some ways, I mean, obviously there's this sort of talk about this renminbi strength, right? That there could be some repatriation back into yuan assets, for example. Is there a sense that regulators and policymakers are having more of a structural change in how they look at the currency now in China?
Well, definitely we have been seeing some appreciation of the yuan against the dollar. But actually, in the last few weeks, the renminbi basket has not been on a straight path to appreciation. And in fact, if you take out the last few days, the renminbi index has actually weakened. I would say at this point, the renminbi index is right in the middle of where the authorities are comfortable with. But I wouldn't push my luck because what we're really looking at is the dollar yuan riding the decline in the dollar. But I don't think the authorities would want to pursue a continued decline in dollar yuan should the dollar turn persistently from here.
Okay, so the risk for treasuries in the dollar, I mean, this sort of diversification theme, do you think that we'll see more of this moving forward? I mean, what are the conversations that you have with clients now on whether we might see more volatility around dollar assets moving forward?
Actually, I think what is more likely to drive the volatility in the U.S. Treasury is the other investors of U.S. Treasuries. So I already mentioned, China owns only around 2.4% of the foreign-owned U.S. Treasury. But then you have the Fed owning around 30%. Then you have the depository corporations. Then you have the mutual funds, and then the foreign owners. And then the others, which is approximately 25% of the outstanding U.S. Treasuries. In my view, the others are more likely the institutions that tend to go in and out of the market, unlike the central banks that try to hold on, which is likely to lead to a more volatile environment, because if you have hedge funds coming in and out and they already own around 25%, that's going to be the market mover, not coming from the Chinese strategy's point of view of lowering their holdings.
Yeah, and what about Japan then? I mean, obviously, given what we've been seeing with the fiscal sort of expansion that's likely to happen there is this sort of narrative that, Japanese investors might be willing to look back on shore, given that JGB yields are now, relatively speaking, offering value now. How real are those sort of repatriation sort of issues here? And certainly, would that lead to more concerns around, treasuries and the outlook there?
Definitely, the higher bond yields in Japan is becoming more and more attractive. But we have to look at the timing. In Japan, the fiscal year will end in March. I don't think the Japanese institutional investors would want to take on a huge risk at this point, considering the very volatile position. Nobody wants to lock in a loss in the last 3 months of the year. Having said that, they might be coming in by April, which would be understandable considering that the yields in Japan are already attractive and the BOJ will be pulling back on the pace of their quantitative tightening by April as well.
Okay, in terms of FX side of things, then, I mean, we thought that, after this, what was going on with Japan, that we've been talking about 160 for dollar yen right now. We haven't quite hit that. It seems like at least what we heard from the finance ministry is that they're trying to at least try to verbally calm, traders down right now. But how long lasting do you think these moves on dollar yen going to be?
I think as long as we do not have details as to how the consumption taxes will be cut and how that will be funded, no matter how much the government is trying to talk the market into believing that they will continue with a prudent fiscal stance, the market would be very, very wary. So we're looking at timing here. We have to look at the release of the budget of the Japanese government, and then we have to look at the supplementary budget as well. So we're looking at the fiscal year end, which would affect the demand from institutional investors. We're looking at the budget, and then we're looking at the supplementary budget. So until then, all the government or all the cabinet can do is try to assure the market that they will remain prudent. But at the end of the day, we don't have details to hold on to.
Also, another thing that we've been tracking is what the dollar moves and the like. I mean, what we heard from Kevin Hassett was that expect jobs growth to start slowing down. What assumptions should we be making about the dollar? Obviously, there's a lot of concerns in the market about Kevin Warsh as the Fed chair, and maybe he might be seemingly a bit more hawkish as well. Does that change how you view, what changes could be coming for the Fed?
Right now, the market is already pricing in a little more than 2 cuts. Now, our view is that there will be 3 cuts for this year. But so the market basically has room to price in a little bit more. But after that, even before the end of the Fed cutting cycle is over, the market would already price that in. So our view actually is that the weak dollar story is already on its last legs, because we don't need for the Fed to finish cutting for the market to think that it's already finished cutting. Our view is that the euro dollar would peak in Q1, possibly extend to Q2, and then we see a decline in the euro dollar. That would actually mean that overall dollar would start to go higher by the second half of the year.
There's also a lot of anticipation of what Kevin Warsh can do when it comes to the Treasury framework, right, and the balance sheet. Some have said there might be, he might face challenges when it comes to shrinking the portfolio of the Fed. What's your take on that?
Well, it's definitely going to be interesting, right? Because market is already becoming more and more wary of economies of governments that have elevated debt to GDP ratios. So far, there hasn't been that question on the US, but we've already seen it happen in some of the G10 economies. I wouldn't be pushing my luck at this point if there is a continued spending in the U.S. government and then you have a continued decline in the Fed holdings of the U.S. Treasuries. It's really difficult to continue in that path, I would say.
Okay. So how do you think this Kevin Warsh sort of nomination is going to really shape the Fed then? I mean, he seems like a bit of an inflation hawk. Is he going to have the soft power, you think, to really align the rest of the FOMC? Or can he still kind of continue this rate cutting path that markets are still pricing in?
I mean, there is room for 3 more cuts. So it's not like the market is suddenly going to be surprised for him to start hiking, even though historically he had been an inflation hawk. So we do have room for continued cuts here. It's only a question of when he will start to look at when the end of the cuts will be. So at this point, I think the market is complacent that there will be cuts, and to be fair, there is no change in inflation expectations that would suggest that he should become hawkish.
All right, Eugenia, we'll have more coming up with Eugenia Victorino, the head of Asia strategy at SEB, joining us out of Singapore. Coming up, we'll talk more about Japan. Tonight, Takaichi's election landslide presents a dilemma for Xi Jinping, whether to engage or turn away from an emboldened Japanese leader. A closer look coming up next. This is Bloomberg.
We're talking about responsible, proactive fiscal policy, but the responsible part is crucial. Our policy is to secure market confidence by ensuring fiscal sustainability, by steadily reducing the debt-to-GDP ratio.
Japanese Prime Minister Sanae Takaichi there speaking after her party's landslide victory there at the lower house election. So certainly that was a big one here, and we continue to see that tailwind when it comes to Japanese stocks here this morning, and certainly how far this Takaichi trade can go. I think many have told us this is more of a multi-year sort of thing. We also heard from the Chinese Foreign Ministry's reaction to her resounding win.
The election is the internal affair of Japan, but this election reflected some deep-seated and structural issues as well as certain emerging views, trends, and developments, which deserve serious examination by people with insights in Japan and the international community. The lessons of history are still fresh in memory and should not be left behind. We urge those running the Japanese government to take seriously rather than brush aside the concerns of the international community.
Now, Takaichi's election victory presents Chinese leader Xi Jinping with a dilemma now, whether or not to engage with one of Washington's top allies in Asia. For more, let's bring in our Japan politics and economics reporter, Sakura Murakami. Sakura, thank you so much. I mean, I guess you could say, whoever, lost in this Japanese election might be the Chinese, just given the fact that their political and economic pressure on Japan has in some ways backfired and maybe in some ways solidifies Sakura's Takaichi's sort of victory over the weekend. What do you think this mandate for her now means in terms of a foreign policy perspective?
Yeah, absolutely. I think, the comments that Prime Minister Sanae Takaichi made about Taiwan last November was actually sort of well received by the public. It seemed like she was taking an assertive, strong and bold stand against China, and that actually went down pretty well with the public. And it's all part of Takaichi's brand, having a strong and assertive Japan, and that may not that would kind of pose a dilemma to President Xi of China. At the moment, China is basically, again, reiterating the need for Japan to retract its comment on Taiwan, whereas the Prime Minister Takaichi is probably not going to do that. That's going to make her appear weak, and the consistent stance of Japan is that there's no change in Japan's policy on Taiwan. So there's a bit of a gap there between Japan and China.
Yeah, so there's still a bit of a gap there in terms of geopolitics. What about when it comes to what the market has looked at, right? Whether these, fiscal concerns about how she's going to pay for this planned tax cut. Now that she's solidified this victory, how is she going to give that message or send that message to investors and overall market participants?
So in a press conference yesterday, Prime Minister Takaichi, she didn't give a lot more details on the funding for the sales tax cut, for example, but she gave some hints about what to expect in the future. She said we can expect a report by summer, basically, so that's something to look out for. She also said that the funding will come from subsidies, from a revision of subsidies and tax exemptions. But there's no details there yet. yet. The question is whether there are enough subsidies and, what tax exceptions can be revised to cover the shortfall of 5 trillion yen annually if the sales tax cut does happen.
All right, Sakura, thank you. Sakura Murakami there, our Japan politics and economics reporter. Eugenia Victorino, head of Asia strategy at SEB. She's still with us. Eugenia, it's interesting, right? I mean, it seems like Japan can't really have a stronger currency and also lower bond yields in some ways, right? I'm just wondering, which do you think is going to be the lesser evil of the two for Japan?
I think at this point, it's really the bond yields. So if the bond yields are really going to go up because the market is going to panic that the fiscal position of Japan is going to deteriorate substantially, then there really is no way for the yen to appreciate, considering that the institutional investors, the local institutional investors, are still going to be in the red. Now, having said that, there is some truth to what the cabinet has been saying, that actually the debt to GDP ratio in Japan has been going down. The reliance on debt issuance as far as government revenue is concerned has also been going down. And that's only because the income tax revenue, the corporate tax revenue, and consumption tax revenues have been going up thanks to the high inflation. So basically, in the last few years, Japan has been growing out of its debt, which is very formulaic, at least as far as IMF would suggest when they talk about debt sustainability. But once you talk about consumption tax cuts, then there has to be an assessment. How long will they be able to do that? To be fair, Prime Minister Takaichi ran on the pledge that it would only be for 2 years. Unlike the other parties, they were actually gunning for a permanent tax cut. So I would say this is actually the better of the other evils as far as providing support on offsetting the high cost of living at this point.
I see. I want to switch gears because you do have a non-consensus call when it comes to dollar yuan. You still think that we could be heading back to above 7 levels. Why so, Eugenia?
Yeah, so actually at this point, we're already at 690 for dollar CNH, and that's really because dollar continues to sell off. But as I said a while ago, we do expect that the Fed will cut up to 3 times, but the market has already priced in a little more than 2. I don't think the market can continue to ask for a weaker dollar unless the market is willing to price in a 4th or a 5th cut for the year. And looking at the totality of the data in the US, there is no need for that move. So I don't think the dollar can continue to go down unless you have a fresh catalyst from here. As it is, the dollar bears are trying to look for drivers to justify shorting the dollar.
Eugenia, thank you. Eugenia Victorino there, head of Asia strategy at SEB. So 710 by end of 2026 for offshore China. Coming up, AI spending is soaring, but failure rates near 90%, and power limits at data centers are raising investor concerns. We have tech analyst Rob Enderle breaking down the risks for us next. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand as mainland China heads to a lunch break. Japan returns from the break, and we continue to see when it comes to Nikkei 225. There you go. We're up north of 2.5% here right now. That Takaichi trade and the election sort of tailwinds continue for a second day here. CSI 300 are pretty flat here right now, but Hang Seng is still catching a bit here this morning. We're up about 0.2%. So yes, it seems like Asia stocks still holding around those records here right now, and really on the back of what we heard overnight when it comes to the U.S. tech side of things, and really what we heard from Alphabet, right? The Google parent company is going on a global bond spree, raising $20 billion to fuel the unprecedented spending plan behind its AI push. Let's bring in our Asia tech correspondent, Annabelle Jewelers, for more. There was a lot of concerns about, all these tech companies going to the debt markets here. It was really going to weigh on credit. And then you talk about what happened with Alphabet, and that seems to push all those concerns onto the wayside in some ways.
Yeah, it's been super interesting because, to your point, that was one of the biggest concerns that came out of the big tech earnings last week was really that concern around that CapEx spend. Was there enough ROI, and would there be the investor demand to meet it? And I think that's the part of the equation that's actually been answered here, because Alphabet, the numbers are pretty phenomenal. It's not just $20 billion in a bond sale on Monday, US dollar denominated debt. So that's the biggest ever offering for the company, but it's also $15 billion more than was initially anticipated. So it's huge. And then you look at the investor demand, and it was around the $100 billion mark. So clearly there's a lot of investor interest in this space, and it sort of speaks to overall the space. I mean, you've seen that sort of market reaction today. Tech is rallying off the back of it. So there's, I guess, some fears have been assuaged, but it also speaks to what is the needs of Alphabet this year, because we saw in their latest earnings that their CapEx plans for this year are around $185 billion. And that's significantly more than it's spent on the past 3 years combined. So this debt offering, but you're also looking ahead to future debt offerings in the UK, for instance, where you're going to see a 100-year tenor, for instance, being offered, possibly Switzerland as well. So this is just sort of the start of what else is to come, essentially.
Yeah, and there's also this FT report about the U.S. is floating the idea of maybe exemptions when it comes to these chip tariffs for some of the big tech companies. What's the rationale behind that?
Yeah, this is an interesting one as well, and it's sort of a little complex around the way that it's going to be structured, because it is relief for the cloud service providers, essentially. But the way it's being done, at least according to the FT reporting, is that the exemptions are going to be handed out to TSMC. So this is what they're saying, is that in January we're expecting the White House said that they were going to be imposing significant duties on chip importers, so that would hit the hyperscalers. This new scheme, though, is going to allow TSMC to allocate exemptions for its US customers from this next set of tariffs. So again, that's according to the FT. How much they can do that is tied to the scale of TSMC's investment in the US, and we know that they've pledged significantly more. They're looking at $165 billion now that they're pledging to the country. It's also been part of that recent US-Taiwan trade deal as well. So it speaks to that balancing act, essentially, that the US has here, because they do need to spare companies like Amazon, Google, Microsoft, because they're building up such presence and such infrastructure in the US, but at the same time you can't disincentivize, or the US doesn't want to disincentivize companies like TSMC from onshoring a lot of their production to the States as well.
All right, Annabelle, thank you. Annabelle Jewellers there, our Asia tech correspondent, on the latest when it comes to Alphabet, as well as what it means for the chip makers and the like. Joining us now is Rob Enderle, president and principal analyst at Enderle Group, a consultancy firm that serves the tech industry. Rob, it's good to have you. Let's start with the Alphabet story, because that certainly raised a lot of, I guess, eyebrows. I mean, just a few days ago, the markets were really questioning all the massive AI capex numbers that were coming out from the likes of Alphabet, Microsoft, and the like. And now you see, $100 billion of demand that it drew in this debt offering. Does that brush all those concerns aside now?
Not entirely. It does show that there's a lot of interest in the investor market for this kind of a property. So they kind of undersubscribed what they had potential for, and they do need, as you pointed out earlier, $185 billion to build out their plants. But the second half of the year is really where the risk starts to accelerate, largely because the technology that they're building, or they're using to build out these data centers, is advancing at about a 4x rate. Now, typically in this market, if you get 20% of a performance increase a year, that's amazing, and it drives early swap outs of the older technology. We're talking about 400% increases year over year in terms of performance, which means by the time you finish building one of these plants, it's a good chance it's going to be really obsolete. Not to mention the fact that a lot of the AI deployments, up to 90%, depending on who you listen to, I think 90% was Gartner's number, have been failing. And so the underlying buyers are looking at this and saying, you know, this buying on proof of concepts isn't working for us anymore. We want this stuff to actually work. Now, the good news for Alphabet is Gemini is actually working very well. Currently, it's rated the top of the AI engines in its class. But even so, there's a lot of risk as we enter the second half of the year.
Okay, there's a lot of risk. How do I navigate around that, right? I mean, up until now, it was always the hyperscalers But now you're talking about, memory chip makers seems to be really catching a lot of the spotlight here these days. There's also people talking about, I'm going to rotate more into the energy, the power grid sort of space around this whole AI story. What's the best way to position now, Rob?
Well, really, I would suggest exercising caution. This is a case where if you're building out a data center, you really want to wait till towards the end of the build to specify the technology. Don't do it at the beginning, because the technology is going to change so much during the build process as you're constructing these large plants. Also, you really have to be very careful about what the consensus is in the communities where you're wanting to build these data centers. There's been a massive amount of pushback over here with data centers, with communities around data centers saying we don't want it near us because we don't want our power bills to go way up. And so you're seeing companies like Alphabet buying power plants. Unfortunately, power plant technology isn't advancing as quick as the AI stuff is. So that's a relatively stable way to buy in, or at least offset the energy problem.
So you mentioned that 2025, I think people just the talk of AI was enough to send these stocks rising. What is 2026 going to bring, right? You mentioned there needs to be more proof of concept this year. Is this really going to be the year where you need to really see how AI is really being deployed and really applied for investors to really kind of get more conviction and confidence behind these sort of companies now?
Yeah, the term that's being used right now for 2026 is the year of truth. This is the year when AI really needs to show what it can actually do, not what it can promise to do. If it continues to underperform expectations, there's going to be a sharp pullback in the second half of the year, and a lot of these data centers may find themselves with no customers to fill them up. Not to mention, we've got a massive amount of competition. This kind of money thrown at a technology, very similar to what we had in the dot-com era, causes an awful lot of development to happen over a short period of time. And so the people that are currently leading the market may not be the companies that are leading the market in 2 years. And so it really requires people to keep their eyes on the market and make sure that they pull out before one of these companies collapses. ChatGPT, for instance, and OpenAI is clearly in a lot of trouble at the moment with regard to the cash reserves, and they were the star last year. This is a case where you really need to keep your eye on the market, keep your eye on the companies, and be prepared to move rapidly if things start to change.
Yeah, I think NVIDIA on the whole AI investment, when it comes to OpenAI, really kind of brought that to light in some ways. So in terms of looking out for the emerging winners, do you have your eyes on any sort of companies right now who are going to be the next sort of leaders in this whole AI story?
No, at this particular point, there's too much turmoil. We saw one of the AI companies come out with a legal application.
Yes.
Blanking them. And they spun the market.
Yeah.
Anthropic, thank you. It was Anthropic that did it. For some reason, I just blanked on the name. But Anthropic did that, and we're going to get a lot more of that as we go forward. I mean, Anthropic just woke up the market, which means the other providers are going to be looking at plugins themselves and focusing on different market segments. And honestly, I think it's probably the best way to do this. Rather than these generic AI platforms, now begin to focus and optimize them against a particular industry vertical. And that makes it much harder for somebody to dethrone you, because once you gain a competence in the industry, that is something that can last regardless of the performance that underlies it. And so that's probably the best path. So you're looking at companies that are actually focusing on industry verticals, learning that vertical and becoming embedded with them. That vertical will stick with them as long as that knowledge holds, and they can survive some of these technology shifts.
Yeah, what does that mean for software? Because I think that was what Anthropic, laid that thread out when it comes to these AI tools, that, they were able to kind of look through legal documents, everything from financial research and the like. I'm just wondering, were those concerns in the market a bit overdone, or do you think that, these AI tools really have the capabilities to, lead to steep losses for these software companies, or even, lend themselves to be obsolete one day?
Well, you remember Jensen Huang, the CEO of NVIDIA, came out and said, if you're going into software don't. The software engineers are about to become obsolete. Now, mostly it's entry-level jobs at this particular point, but you've certainly seen large layoffs from some of the majors as they adjust their staffing for the performance improvements that they're achieving with even non-optimized tools. So yeah, there's a lot of turmoil, and what's going to be happening with software companies, as you saw with Anthropic, it kind of pulled the rug out from underneath the SaaS vendors, and that's been kind of problematic. But honestly, I think that's what we're going to be seeing going forward. It's going to take a while for this industry to stabilize. There is so much going on at the moment, from technology advancements and pivots like Anthropic just did, that this is not a place for the faint of heart at the moment.
Yeah, it's good to kind of have someone that can kind of bring us back down to earth in some ways, Rob. When it comes to this FT report about the U.S. also floating exceptions when it comes to chip tariffs for some of the big tech companies, when you saw a headline like that, do you think how big of a deal do you think that is going to be? Is it going to be a big relief for some of these companies now?
Well, it could be a big problem. The issue with tariffs is they're changing too rapidly. If you're going to try to commit on a large manufacturing site, it's going to take you 3, 5, 7 years to bring that site up and have it produced. If tariffs are changing quarterly, monthly, or even annually, that means that the very foundation for your build may not be supported as you're halfway through the build. In other words, you might be halfway through the manufacturing plant, and suddenly the tariff thing has changed. We've got the fact that Trump may not have the authority to issue tariffs. That's being reviewed by the Supreme Court. And if they come back with a ruling, which a lot of us are expecting, that says he doesn't have the authority for tax, which he shouldn't have, that should be Congress, then that changes the underlying dynamic for an awful lot of the activity we've got going on right now. And so my sense is a lot of these folks are talking big numbers and big plans, but I think we're going to see them hold off on really doing much in terms of investment until they're sure that the tariff situation is going to be stable long enough for them to get a return on their massive investment in these plants.
Yeah, Rob, and it's interesting, right? Because given just what you've laid out, right, the risks around all this CapEx build out and the like in the U.S., it really contrasts in how people look at China AI, for example, where, the CapEx numbers are not as ginormous. It's more for practical applications. You're starting to see this whole kind of full stack being developed. I know you focus mostly on U.S. tech, but how do you compare the two sort of paths of AI between U.S. and China right now?
Well, right now, the Chinese government is throwing massive amounts of money at this, and it's having results. The U.S. government is not doing the same thing. They're mucking around with tariffs, but not really with government investment. And we've seen that this huge ramp of China's capability to the point where it appears they're moving far faster than the U.S. is in terms of advancement. Right now, their autonomous driving and robot efforts are well ahead of anything we've got in the U.S. at the moment. Just shot right past our capability, and their base AI capabilities have been focusing on efficiency, and so they can do things that are similar to what we're doing on Blackwell on down level chips that are 3 or 4 generations behind, and it's still performant. And those kinds of efficiencies we're not seeing here yet, and that's all very concerning. So one, government spending tons of money to help out their companies, and number two, they're advancing in ways the U.S. companies aren't really advancing, at least not as aggressively right now, which I think is going to be problematic as we go into 2027.
Rob, always great to have you. Rob Enderle there, President and Principal Analyst at Enderle Group. Let's stay on tech here because obviously we've been focusing a lot on the whipsaw movement. We see it in Korea markets here. That stunning $1.7 trillion rally in the Kospi has still not really been enough, though, to close this valuation gap to global peers. For more on this persistent Korea discount, let's bring in our Asia equities reporter, Sang-Mi Cha. I thought it was a very interesting point you brought out in this story. Given just so much optimism around Korea, why does that discount still exist?
Yeah, so Korea discount is the perennial markdown of this valuation, and it's tied to that governance issue, right? Because Korea has these family-run chaebars, and these comes with so many of these cross-shareholdings and so many of these reforms that are needed in this space to actually boost valuations. But on paper, when you look at it, the price to book ratio, Korea has climbed quite significantly. It's at 1.7 times now, on par with where China and Japan is. So, on paper, traders say, yes, that valuation has been narrowed. But again, when you look at the rally itself, which has doubled since the start of 25, it's all driven by the chip stocks, right? Samsung and Hynix have contributed more than half of the cost-piece rally during this period. So we're talking about tech and AI a lot, and of course it's a record shortfall in memory chips that's driving these chips, but still it has to broaden out a little bit. But even looking at Samsung and SK Hynix alone, they are still very cheap compared to their global peers. We're looking at TSMC, which is traded at 19 times PE, whereas Samsung and SK Hynix are single digits right now.
Tell us a bit more about you guys have a great story to tell about memory chip prices, right? Where some people have thought, how long can this super cycle last? Because you're starting to see the winners and losers really play out across markets. When you take a look at the console makers like Nintendo, Apple suppliers that are really being weighed down by the surge in prices, whereas Samsung and SK Hynix continue to head higher in some ways. How do we sort out the winners and losers here right now? And what are people saying about how long this cycle can really last?
Right. So the sell-side analysts always tell us that the super cycle that we have seen last year, it's a continuation of that. And of course, the memory makers that were just, they were not always the ones that everybody were looking to, book earlier in advance. It was always the contracts were always quarterly based. But now it's moving towards 1 year product, 1 year project now, because they really need to get the capacity booked for their future AI resources, right? So this is what's happening. It's a structural shift that we're seeing, and this is why Samsung and Hynix are turning out to be winners there.
Meanwhile, you've been talking about what regulators in Korea have been doing and actually looking to a crypto exchange. What do we know at this point?
Right, so it's called Bithumb, and it's a crypto exchange where there was a clerical error from an employee who keyed in the Korean won instead of keyed in the Bitcoin instead of Korean won. Oh. So instead sent $40 billion worth of Bitcoin to some of its users, prompting a panic sell within the crypto exchange, and it's resulted in an 18% drop in Bitcoin in just that period of time. So that's really, stoking a lot of fears now. The ghost Bitcoin, that's what the regulators are calling, and they're saying, is this even possible when, they didn't even have this much Bitcoin in their reserves? So it is prompting some kind of scrutiny.
Yeah, I thought of fat finger, but I like ghost better. Crypto there. Sami, thank you. Our Asia Equities reporter Sami Cha there on all things Korea here this morning. Coming up, we're talking about India. Farmers there in revolt as U.S. trade concessions spark fears of deeper pain for domestic agriculture. And the backlash could push India to rethink its next big move. We have the latest from New Delhi next. This is Bloomberg. Welcome back. You're watching Insight. Let's check in on India markets here right now. Just a couple of minutes into the trade, and you are seeing the Sensex at least catch a slight bid here this morning. We're up just about a fifth of 1%, but above that 84,000 level for the Sensex here. We're tracking, of course, what goes on with the rupee. We're pretty flat, despite some of the dollar moves that we've seen and the weakness that we've seen of late here, but we're still holding around that 90 level for dollar rupee now. In terms of one of the stories that we've been tracking out of there is, of course, India's biggest farmer groups will go ahead with a nationwide protest this week over worries around concessions made in the U.S. trade deal. Now, the protest may include a strike on February 12th as details of the trade agreement trickle out. For more, let's bring in and go to New Delhi and bring in our South Asia political reporter, Swati Gupta. Swati, it's good to have you. So it seems like these protests are going as planned. Tell us a little bit more about the concerns that this group is raising now.
Yeah, so there is very little clarity that the Indian government has provided on the details of this interim deal, and that is causing a certain amount of fear and is making farmers jittery about what India has promised the U.S. The few details that have come out show that India has made small concessions in agriculture. They have either cut or eliminated tariff duties on a few agricultural products, including GM byproducts. India has been very against getting any GM crops into the country, and the byproducts are also treated with suspicion. And for farmer groups, it feels like it is sort of the US finally has a foot in the door, and eventually, year by year, they will push the door ajar. And for the farmers, it's a huge problem.
So how do you think the government is going to respond to all this right now? If we do see more protesters on the streets, how can they kind of appease at least the farmers now as we seek more clarity on this trade deal?
Yeah, so the government has been pretty proactive in trying to allay fears. So even before the trade deal was signed, while the negotiations were going on, Prime Minister Modi was traveling across the country and in his speeches would talk about how he will not sell out the Indian farmers to any country whatsoever. And after the announcement of the deal, different officials have come out and they have reiterated the same point over and over again, that India is still not opening up the sensitive sectors. But India is mostly made up of small farmers, and for them, the introduction of, or even the thought that GM products could enter the country is devastating. So what we need from the government are more details on the deal, which are right now not forthcoming.
All right, Swati, thank you, Swati Gupta there, our South Asia political reporter, on, of course, what this means for India farmers, this trade deal with the U.S. Still ahead, though, as investors stay focused on swings in gold and silver, BNP Paribas commodities strategy head David Wilson gives us his global metals outlook. Plus, we're talking more about ASEAN with J.P. Morgan's Pauline Ng on the bank's 2026 ASEAN investment strategy. More to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Take a look at when it comes to markets here this morning. We continue to edge higher when it comes to Asian stocks here. We're hovering around that 1% level when it comes to the benchmark here today. So we are hitting a fresh record once again. It's really kind of the U.S. tech story with Alphabet, with that massive debt sale there that really kind of drew so much demand, that really kind of lifted the whole tech complex here in the Asia session today. So the Nikkei is still hovering around 2.5% gains here right now. Topics and Kospi are doing quite well. Taiwan is also up 1.5%. So certainly the North Asia side of things is still looking pretty strong this morning. We're still seeing some weakness in the dollar as well here. You take a look at what's going on with the dollar-yen trade. We're at 155 levels here right now. You talk about dollar China, and that's hitting 2-year highs for your offshore and onshore rate here. So that certainly is one thing to watch. And, of course, commodities, right? When you take a look at how gold prices are, we're back above that 5,000 level. Certainly is that sign of stability here. Even Bitcoin, we briefly touched that 70,000 level as well. So where does that leave this whole sort of debasement trade here as well? We're also watching crude markets as well, just given the geopolitics around Iran and the like. We are seeing Brent at least hovering around that $69 level here. More when it comes to oil, and certainly what does it mean? We did speak with Carlyle's chief strategy officer, Jeff Currie, and he says the market is, quote, substantially underinvested. We asked him whether prices are primed to break out to the upside despite the apparent oversupply.
Apparently a lot of supply. I like to say, show me the glut. At this point right now, the high frequency data, the last week we showed, substantial draws. They've been telling this oil supply glut story for 18 months now, and it still has not materialized. And whether it's you're looking at the forward curves, and they go, oh, well, it's sitting at oil at sea. Well, a lot of that oil at sea is sanctioned oil that can't be touched. And if you're having to scrape the data to find evidence of this oil supply glut, it's not an oil supply glut. These things hit you over the head like a sledgehammer. I think at this point right now, you had a big short in the market coming at the end of last year. In fact, it got up to 230 million barrels, bigger than the oil supply glut. So this apparently, in expectations of a glut, has had a bigger impact on the market than an actual glut. And now we come into this year, you got risk around Iran, the geopolitical risk, and now we're seeing the unwind of that big short. But I think the key point here is fundamentally we still have not seen anything other than a cyclical weak patch that we saw towards the end of last year as that OPEC increase in supply hit the market. But I think the main message I want to leave you with is these markets, whether we're talking oil, metals, all of the old economy is substantially underinvested. You look at oil, the last of the non-OPEC supply surge comes through this year. There's really nothing behind it. We have not seen investment in refineries, copper mines, the rest of it. And that's really at the core of our call for a commodity super cycle. Combine that with policy-driven demand that will likely continue to keep these markets tight. I think there's a lot of upside here.
Now, the one the question I have, at least in the short term, Jeff, is about Donald Trump. I mean, he seems to measure his success on how low the prices at the pump are. And so it would strike me that, if there's this much sanctioned oil on the water, he's going to get the sanctions off to get that oil here quickly if we see the price start to creep higher.
Well, I mean, you look at the draws that you had last week. Clearly, there's the ability to accommodate it. But I think there's a bigger point here. Is yes, let's say you have a little bit of a glut out there. Let's say it's 50, 100 million barrels that could be brought in if you got rid of the sanctions immediately, which I think would be really difficult to do, and nobody expects that. It's not going to solve the longer term problem. And what we're seeing in the metals markets, you've got copper. Yeah, it sold off last week, but we're back above $13,000 a ton again, which is an indication that this market is structurally short. All of these markets are structurally short. They're global in nature. And the fact of the matter is, with all the geopolitical uncertainty, there's a high incentive for consumers around the world to hoard commodities. President Trump just announced his vault. The vault is hoarding metal for the United States. China's been hoarding oil because they're structurally short oil. India, Europe, also structurally short oil. So I think these all got to be factored in, that you have these geopolitical risks that are incentivizing hoarding. At the same time, we haven't invested. And we call this the revenge of the old economy. And it's a rotation out of the new economy, tech or asset light, into the old economy, which is asset heavy. Mm-hmm. Now, to give you some numbers, NASDAQ is down 9%, metals and mining is up 25%, and energy, despite the oil glut, is up 22%. So that swing is over 30%.
Jeff Currie there, Carlyle's Chief Strategy Officer, speaking to Matthew Miller there over in the U.S. overnight. So certainly a lot to talk about when it comes to metal markets. Let's bring in David Wilson, Director of Commodity Strategy at BNP Paribas. David, it's good to have you. I mean, gosh, last week was certainly something that sent everyone in a tailspin in some ways. You take a look at the volatility that we've seen across the metal space. I mean, gold's back above 5,000. I'm taking a look at Bitcoin. It's back close to around 70,000. I mean, do you think we've seen a little bit more stability now, or has the dust still not quite settled yet?
I mean, the one you don't mention is silver, which was incredible. I mean, we hit those highs of over 121 dollars an ounce, and then dropped to 63. We're back up sort of in the 80s at the moment. So, I mean, incredible volatility. I think it depends on which metal you're going to look at. I think silver, the driver has been, we've seen a surge in physical buying, particularly here in Asia. But the physical market is easing rapidly. A lot of metals flowing out of the US back into Europe and Asia. And it feels to me like as we get into the Chinese New Year, that's going to dry up a little bit. So I think for that one, we're going to see some more downside. Gold, different story. I mean, look, I think we've seen broad-based buying. It's not, not particularly geographically specific. We've seen it broadly across everywhere. And I think, given the extent of macroeconomic risk, geopolitical risk, there's going to be a more upside in gold.
Okay. Let's talk a little more about the speculative part of it. I mean, that's really what came out in China, right? You talked about what silver prices are doing. Are we likely to see, I mean, you say demand might actually come down now that we get closer to the Lunar New Year holiday, but I'm just wondering, where does this leave the whole speculative trade here right now? I'm sure a lot of retail investors in China are really nursing their wounds and really kind of thinking about whether to come back in. Is the silver market essentially in some ways broken, you think, David?
I mean, it feels like it because, look, if a lot of the retail investment was getting in, through December last year, we went from, 58 to that 121 move. So, so a lot of people getting in from mid-December onwards have faced quite considerable losses. So you'd think there would be some degree of reticence about getting back into the market. But having said that, we did see significant buying in the last week. But against that, look, we are seeing demand destruction from the industrial side. I mean, you have to remember that well over 60% of silver usage is in industrial end usages, and that is being impacted by, well, not only by the high prices, but by the extreme volatility. So to a certain extent, we are seeing industrial users trying to find alternatives, trying to move away from silver exposure. We see it in solar. We see it actually in the sort of AI data center, electronics sectors as well, where they're trying to thrift the usage. So there is a long-term impact of this extreme volatility for sure.
What metrics do I have to look at now? I mean, in terms of factors at play, that's going to be changing the course of direction for precious metals. Is it more about central bank buying? Do I look at ETF flows? Do I look at inventories? I mean, what do you think is going to be the key thing that's going to be driving the precious metals trade moving forward, David?
I mean, look, if we look at gold, yeah, as you mentioned, I mean, central bank buying, we continue to see that being very present. I mean, we had, I think it was a week and a half ago, we had the Polish central bank saying that they're going to buy another 150 tons of gold, having been the biggest central bank buyer of gold last year. We continue to see ETFs accumulate gold. There was a little bit of a drop last week on the correction, but there's been a pickup since then. We saw significant retail investor interest in buying physical gold after the drop last week as well. So there seems, as I mentioned, there seems to be more broad-based support for gold. But then if we look at, say, silver, the opposite's been happening. I mean, ETFs, apart from the day that prices dropped last week, where there was a sort of an inflow, generally it's been an outflow. Year to date, we see outflows. We've seen lease rates come off dramatically, which is an indication that the physical market is easing rapidly. I mean, if you go back to October last year, lease rates spiked to well over 20%. Well, now we were down to sort of 2% last week. There's been a little bit of a jump on this sort of surge in Asian buying since then, but generally the trajectory is downwards, which tells you the physical market's easing. We also see CME inventory has been dropping rapidly as metal, it was sucked into the US last year on the fear of tariffs. That fear is that tariff risk is to some extent disappeared after the 14th of January announcement from the White House that there wasn't going to be a sort of critical mineral tariff on silver. Metal's been flowing out rapidly, so that market is definitely easing. So I mean, I think it's disconnecting a little bit from gold. I mean, if you look at the gold-silver ratio, it's still relatively low compared to the average over the last 2 years. I mean, we got down to the sort of mid-low 40s. We've bounced back up to just above sort of 50, mid-50s now. But the 2-year average was in the 80s. So I think there's still room for that sort of further disconnect. And again, I would emphasise, given the sort of the extent of geopolitical risk, macroeconomic risk that the world is still facing, gold, to me, makes sense in a way that silver doesn't provide the same sort of, let's say, risk protection.
Yeah, it sounds like you're still bullish when it comes to gold. What's going to be the forecast then for year end now?
Well, look, I mean, I think we can definitely see prices back above 5,500. So we do see new highs. I mean, we're targeting levels of towards 6. Look, and there's a lot of events still out there through the rest of the year that I think are going to be supportive. I mean, you have to look at what's the outcome of the US midterm elections. I mean, do we get some political inertia in the US? I would argue that if that's the case, then we definitely see more upside.
I want to switch to some of the industrial metal space and what we've been seeing there. I mean, copper obviously has been on a tear, so has aluminum in some ways. How do you look at the supply and demand dynamics there now?
Well, I mean, copper's interesting because you hear this constant narrative that there's no supply growth, the market's super tight. Yet when we look at exchange inventories across the three main exchanges, it's at 22-year highs. All the three pricing exchanges, the forward curves are deeply in contango. We're again seeing this issue of high prices prompting a reaction, particularly in China, where consumers are just not buying. If you go back to, remember, sort of April, May 2024, when prices hit 11,000, Chinese consumers stopped buying spot and prices dropped by August of that year to 8,800 from 11,000. We're seeing that same sort of stoppage or slowdown in Chinese buying activity. Obviously, that potentially is exacerbated by sort of New Year next week, where activity stops. But generally, the main consuming country is balking against these higher prices, and we see this sort of rapidly rising inventory. We see China also exporting a lot more copper over the last couple of months, and that's flowing into exchange inventory, particularly in the West. So right now, short term, it doesn't feel like the copper market is particularly tight. And then we look at, say, US demand. It's actually not been that great over the last quarter, and the US was actually, go back to November, the US was a net copper exporter, and then December pretty flat. So the import surge, again driven by the fear of tariffs, as far as we're concerned, that was pretty much over, non-story after September last year. So to me, it looks like the actual physical copper market is easing right now. And I would argue, I've been arguing for a while actually, the moves above sort of 11,000, 11,500 have been purely speculatively driven when we had this sort of rotation of fund money in Asia and in the US in particular, away from energy and into the metals complex from sort of early to mid-December. But you have to remember with metals, when you get these sort of disconnects between futures pricing and the fundamental market, it's usually the futures price that snaps back towards a more fundamentally justified level. And I think that's likely to happen with copper. With aluminium, we see genuine tightness. I mean, the supply side is really struggling for growth since China capped its production. That's really changed the dynamics of that market.
David, I was going to get your take. I mean, just given the rally we've seen on both of these metals, right? That's despite sort of the growth picture in China that has been lackluster. I'm just wondering, in terms of, do you think that relationship, that correlation of China's growth and demand picture is being more divorced now to the metal space here, particularly as this economy pivots away from property, away from construction, and into more some of the hard tech and high manufacturing industries?
Yeah, look, I mean, I think you're entirely right. I mean, China is obviously still going to remain important. I mean, for copper, it accounts for around about 60% of the world's sort of first-use consumption. So whatever happens in China is still important. But that sort of the delta of actual demand change, I think you could argue, is switched a little bit more to the Western world, or the ex-China world for sure. But here we're seeing, I mean, again, focusing on copper, we're seeing some signs of sort of demand upside in Europe in particular. The German infrastructure spending is picking up. Defense sector, obviously. Autos looking slightly better. But the US is not looking that much better. I mean, we see manufacturing really, really struggling. So to your point, yes, look, China is still important. I think China, you could argue, is in a transition phase. You said old industry, yes, that's slowing. I don't think that comes back as a driver, and we're in the transition to sort of new tech-heavy sectors. So right now, net demand growth isn't great, but it's not terrible. But I'm not too worried about the sort of the future outlook for China. I think it's still going to be relatively positive and important to focus on.
David, it's great to have you. Thank you so much. David Wilson there, Director of Commodity Strategy at BNP Paribas. Well, the International Council on Mining and Metals says that African countries will be making a mistake if they embrace resource nationalism. The council president also told us Chinese influence could help support the potential growth of Africa's mining industry.
The US and China and Europe as a third player offer really important opportunities for the continent to choose which they want to work with without necessarily that having to be mutually exclusive. So you can work with the US and the EU and China in different ways. And the bargaining position for African governments has arguably never been greater, because now you have a choice of counterparties. Previously, when the US and the EU were not as present on the continent, you really only had China to work with. But now you can play China off the US, off the EU. And we saw from the Germans a very clear statement that said, after decades of talking and sending delegations, we're sending engineers and we're sending capital. Now that is what African governments have been wanting for a long time, saying enough talk, show us what you're really willing to do to support the sector. And I would say that today is the most optimistic I've ever felt about African mining.
Where does the leverage sit, though? Is it on some of these bigger economies? Is it on the producers? Is it on the corporates?
Well, the leverage sits underground. Ultimately, the resource base and how rich it is in the continent is our main aspect that we can be using to get the best deals for Africa. Now, that leverage is shared between companies who may hold the rights to minerals or certainly hold the technical expertise, and governments who are the main interlocutors with their counterparties in the United States. Now, and the EU, for example. Now, what we are seeing is a better level of government-to-government collaboration on the continent than we've ever seen before. This year, for the first time, I have seen a maturing of the conversation on beneficiation. Up until now, basically every African government has said, we want everything from mining to refining to smelting to final production in our own boundaries. Finally, people have realized that's not practical. And so we're starting to talk about, well, if mining happens here, can refining happen in a neighboring country, and can final assembly happen in a third country? That's really positive, because that's a much more sustainable way to go than everyone insisting on having all the value chain in their country.
But that still doesn't mean resource nationalism will go away, not just on the continent, but globally. I mean, even in the US, we're seeing President Trump trying to do the same. I mean, where does that fit into this dialogue?
That is the big risk, especially on something like gold, where people are seeing sky-high prices and saying, oh gosh, maybe this asset needs to sit all in government hands and maybe we need to renegotiate contracts. It would be a huge mistake, a huge own goal on the part of countries on the continent if they were to try and use this moment to radically reshape the sector by tearing up contracts, by arbitrary tax demands, by changing the way agreements have been set up, because that will be the signal to international investors that risk is too high and they will put their money elsewhere. So I really would guard against anybody thinking that this is the moment to arbitrarily change. It doesn't mean that you can't have a grown-up discussion about the fairest way to share the profits, but it does mean you've got to be very clear-eyed that the excitement we're seeing around critical minerals today will not automatically translate to dollars in your country unless the environment is conducive for it.
That was the International Mining and Metals Council President Rahitesh Dhawan there speaking to Jennifer Zabasaja. We have plenty more ahead. This is Bloomberg.
Weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, now for a full hour only on Bloomberg Television.
Up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
is integrated into every aspect of our lives, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Tom McKenzie in London. Watch Bloomberg Tech Europe. New episode Friday, only on Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We have some breaking news right now on Insight, and this is regarding StanChart. So there is a bit of change when it comes to the CFO. So they have named Peter Burrill as the interim group CFO and replacing the current CFO, Diego Giorgi. So this is the latest that came through from the company. So we'll see how that all plays out here today. But yes, so Giorgi will step down from his role as executive director and CFO with immediate effect to pursue an external opportunity. That's according to a Hong Kong exchange filing here this morning. So Peter Burrill as the interim CFO. All right, moving on now. We're talking Bitcoin here. And when you take a look at how things have been, derivatives seem to be flashing a warning sign here, even after the rebound. And we're back around the $70,000 level when it comes to the cryptocurrency. And traders are still staying defensive with little evidence of new bullish bets. Let's bring in our crypto reporter, Subhashri Ghosh here. Subhashri, it's a daily occurrence now to have you back on the program. Tell us overall, what's sentiment like so far in the market?
And it's an honor to be back here, Yvonne. Thank you for allowing me to be here. So basically what's going on is, overall the sentiment is kind of quite cautious, even if we have seen quite a dramatic bounce back from the lows we saw on Friday last week at around $60,000 to more than $72,000 this week. But the overall momentum of buying continues to remain kind of fragile, weak, because of the overall, the macroeconomic headwinds that we are seeing across different asset classes. I would say, like, if you see the Bitcoin open interest in the options market, they are coming down. That kind of shows the bearish sentiment that you were referring to earlier. That there is still traders are still not very traders are still worried about the concerns going ahead in terms of the risk appetite and the liquidity tightness. So that's the reason that we are seeing Bitcoin kind of quite cautious and tight levels.
Yeah. So what are some of the levels to watch in terms of what's support, what's resistance now?
As of now, we are seeing like $64,000 to be the next support levels if momentum weakens further from here. And on the upside, about $72,000 for Bitcoin. So that is the range that traders are looking at.
All right, Suva, thank you. Subhashri Ghosh there, our crypto reporter joining us out of Singapore here on, yes, it seems like right now sentiment is still pretty fragile when it comes to Bitcoin prices there. Coming up, we're talking FTSE Russell, the latest index provider to raise concerns over Indonesia's investability, following warnings from MSCI. We're going to analysis in a moment with JP Morgan Asset Management. Indo markets right now not reacting too negatively to the news. In fact, we are still seeing upside when it comes to Jakarta, but certainly there is going to be some issues here and what they can work around, because now FTSE Russell is now stalling or at least postponing that March review in terms of their inclusion of this market, right? So certainly that's going to be one thing to watch here. We have Pauline Ng joining us in a moment. This is Bloomberg. Welcome back. You're watching Insight. We're checking Indonesia right now and take a look at the Jakarta index. And actually, we're seeing gains of 1%. Now, that's despite what we heard from FTSE Russell there. They have become the latest index providers who raised concerns over the investability of Indonesia, following warnings from MSCI last month that dealt a heavy blow to the nation's stock market. For more, let's bring in our senior Asia equities reporter, Abhishek Vishnoi. Abhi, it seems like markets are taking this in stride here right now, but there seems like another, I guess, triple whammy here after MSCI, after what we heard from some of the credit agencies last week. So what's next?
Yeah, I mean, it looks like it's pretty much on the expected lines. MSCI obviously commands a bigger market share, so that's the bellwether in terms of moves that Indonesia is planning. And FTSE also saw merit in seeing what MSCI will be doing and then taking a call on what needs to be done in terms of investability weightings of Indonesia. But as you can see from the market's reaction, market had already fallen a lot in the past few weeks. Now there is a bit of recovery coming in. Policymakers have been out there expressing themselves that they can fix this problem by the end of March. Sometimes they've said by the end of April, and some of the brokers have said it can actually happen by the end of this month. So there are rules which are in the process of being implemented. Brokers are already looking in terms of how to categorize which client to fall in line with what the regulators are planning. So it looks like some sort of calm is coming into the market, but it's a long road ahead. Our reporting reflects that as long as Indonesia is on the path of meeting the rules and regulations, the investability concerns that index providers have been talking about, the market may not get downgraded to a frontier status, which bodes really well in terms of flows which are sitting on the sidelines. Once this kind of an agreement comes in, a lot of money might actually come back. But in terms of fixing these structural problems, it's a long road ahead. We wrote a story how the playbook of India can work out for Indonesia, but that cycle actually took like about 9-10 years, and India wasn't facing this kind of problem. You cannot actually shorten that cycle of 10 years into a matter of few months till May. So a lot needs to be done, but in terms of risk reward, what our reporting is reflecting, this is adding to the pressure that policymakers need to follow on their promises that they have been making over the last few weeks.
And so in some ways it could be a good thing, I guess. It kind of raises the bar now that for them to actually or step up in some ways. What do you think, whether it's index providers, whether it's foreign investors, what do you think that's still missing here in terms of reforms for this market?
I think, policymakers have come out with, a blanket rule in terms of 15% free float. Now, to implement that, you need to obviously sell a lot of stakes to non-controlling shareholders, so that needs to happen. But would that happen at these valuations? Would the controlling shareholders be giving away control at these valuations? That needs to be seen. And secondly, I think the primary concern was in terms of opacity of shareholding structures. If you remember, after Asian financial crisis, IBRA was formed and a lot of bad debt actually went there, and that actually was bought off by these controlling shareholders, which actually led to the problem of having a lot of control or lower free float. So in terms of opacity, in terms of figuring out who owns what, I think that is something that needs to be done, and if Indonesia can manage that and come out with clarity on that, I'm pretty sure index providers would be very happy. Right now, the sentiment looks a lot different from when the MSCI warning came in. So it doesn't look like investors, buy side, long only hedge funds, they're expecting Indonesia to be downgraded, to a frontier market. There might be lower weighting, but things are getting fixed, and a lot of flows are on the sidelines of just coming back.
All right, Abhi, thank you. Abhishek Vishnoi there, senior Asia equities reporter on the outlook for Indonesia here. Let's get to our next guest. She heads the ASEAN equity team at JP Morgan Asset Management. Pauline Ng joins us now from Singapore. Pauline, the perfect guest to really talk about Indonesia here right now. I'll start there. Do you think that you've seen enough from policymakers in terms of the reforms that are needed to bring back confidence back into this market?
Right. I would echo most of the points that your previous colleague mentioned. We have seen some really positive moves from the regulator, from the IDX to OJK. We have seen some changes at the senior level management. And at the same time, I think the regulator, together with the support of the government, has also talked about wanting to fix this problem. Our base case is that it's unlikely for Indonesia to be downgraded to a frontier market status. But certainly a lot of work still needs to be done on top of increasing the free float requirement for IPO companies from 7.5% to 15%. We also need to see better quality of that disclosure. I think all the corporates, as well as together with the IDX and OJK, are all on the right track to deliver that sort of improvement to prevent the country from being downgraded to a frontier status.
And our colleague Abi just mentioned, right? Maybe the playbook for Indonesia ahead is what India did in their, capital market sort of reforms. And he says this is, a multi-year sort of endeavor in some ways. What can investors do in the meantime then, right? Is it to stay invested in this market? And what are the chances that this in some ways could morph into some sort of structural derating?
Actually, if you look at the Indonesian market as a whole, if you exclude some of the conglomerate stocks that trade at very high multiple, the banking sector, the telecom, consumer sector, prior to this incident have already been derated. So I think we will urge investors to stay focused on the long-term fundamentals and continue to stay invested in some of these companies. I think when we come on this channel, we have talked a lot about the banking sector in Indonesia. While we acknowledge that a lot of the state-owned banks are going through a slightly difficult time with regards to asset quality issue, if one were to take a longer-term view of the fundamental of the sector, it remains very attractive in our opinion. And if we talk about the consumer sector, again, we have seen K-shaped economy being a problem for not just for Indonesia, for many of the countries in emerging market as well. Competition was extremely high in the consumer sector. Again, we are seeing signs of green shoots of that improving. The government stimulus, the handouts have happened towards the end of 2025, and we are seeing some slow recovery. And last but not least, I think Indonesia is also a market with a lot of commodities. Here, we will stay focused on companies that we like with regards to having very good cash flow discipline, cost discipline, and as well as production growth. I mean, the short-term volatility on commodity prices will no doubt lead to short-term volatility, but that would offer long-term investment opportunity for investors like ourselves.
Okay, so take advantage of that volatility, as you say, Pauline. I want to kind of zoom out a little bit and talk about just your coverage in general of ASEAN, right? Foreign investors, you could say have been quite selective around the space, just given, tech, AI has really dominated what we see in Korea and Taiwan and Japan. And in some ways, ASEAN does get overlooked in some ways. And that's despite that you're seeing tailwinds from the weaker dollar as well. What is now the case for Southeast Asia stocks?
So I would mention 2 points. I think when we take a look at Southeast Asia, it is 6 capital markets, and they're very diverse, right? You have on one extreme end, you have Singapore, which is very developed, and on the other side, you have, of course, more emerging economies, where there's like Vietnam, Philippines, Indonesia. So if you look at MSCI ASEAN, in the last 5 years, the annualized return is only 5%. But there's a huge bifurcation of returns within the 6 ASEAN markets. Singapore is clearly the poster child. I think the last 5 years, the annualized return has been around 10%. On the other end, you have countries like Philippines that have generated negative return in the 5%. So I would say when one look at ASEAN, it is dangerous to take like a once overview and say that ASEAN is good or bad. You really need to look under the hood and look for bottom-up opportunity. I mean, you raise a very good point with regards to AI and technology. I think clearly, if you look at within ASEAN, while we have some pockets of hardware supply chain, whether it's in Penang or in Thailand, by and large, we definitely pale in comparison with the large markets like Taiwan and Korea. I mean, Korea, case in point, the market is up, 100% in 2025. I think January is up another 25% or so. So we are seeing investors looking for diversification away from technology that have done extremely well. And I think the conversation on technology is also broadening out, right? It's broadening broadening out from picks and shovels, the hardware supply chain of Taiwan, Korea, into the main street. How is AI going to transform all companies? AI is going to transform the way we consume, the way we learn, the way we produce. So again, I think it's important to now understand how AI will transform and affect many industries within ASEAN, and there are bound to be winners and losers there.
Yeah, let's start with the winners, because Singapore, you mentioned, is the poster child. We don't really talk about it too much on our programs, which is basically this value unlock initiatives, that you are starting to see more measures from the government here to enhance corporate ROE, for more flows, for more price discovery. What are you seeing so far in this market in terms of really seeing that governance issue come into light? And really, how does it compare with other markets like Korea, like Japan, for example?
Well, I think in the case of Singapore, you have actually seen a led by the Temasek Link company in terms of improving shareholder return, driving higher return on equities from shareholders, and that's through divestment of non-core asset monetization, coming out with new growth vertical, and returning excess capital to shareholders through higher normal dividend payout ratio, special dividends, or share buyback. So I think that has really started with the Temasek Link companies. With the EQDP program, asset managers like JP Morgan ourselves is also taking advantage of this. We have launched a new fund, and I think that sort of initiative is now broadening out from the Temasek Link company, the large cap, into the small mid-cap company. I think it is only this morning you have also seen the Ministry of Trade and Industry upgrading the GDP outlook of Singapore for 2026 from 1% to 3% to 2% to 4%. I think that actually underpins the growth of Singapore extremely well. On top of that, when you look at retail participation in the Singapore equity market, that remains very low. So a combination of corporate self-help, lightening the balance sheet, improving total shareholder returns, driving better ROE, and at the same time, retail participation should increase over time, especially given that there is a lot of Singapore liquidity looking for better returns over the medium term.
What about in terms of Thailand? It seems like we've seen, I think, foreign buying continue for a second month. In January, we're seeing momentum coming back into this market in February as well. It seems to be carrying on after this election over the weekend as well. Could Thailand kind of lead the charge here in ASEAN this year?
So with the results of the election over the weekend, I think we are hopeful that the current coalition government will stay a full term. And I think that's important because by having the ability to stay on the full term, they can focus on some of the long-term structural challenges that Thailand has instead of the short term. So some of the long-term challenges that Thailand faces, which is very well broadcasted, aging population, high household debt to GDP, and of course losing competitiveness in terms of the manufacturing. So we are hopeful with this stronger coalition government, they can start tackling some of these longer term structural issues to put Thailand back on the map for a lot of investors. Now, having said that, there are pockets of strength in Thailand, and tourism is clearly one of the areas that we are seeing a recovery, not just from the Chinese tourists going back to Thailand, but they have also since COVID developed new tourist sources from India. And on top of that, medical tourism is an area where Thailand has very good competitive advantage, excellent healthcare at very competitive prices compared to the region. So in the meantime, some pockets of green shoots there. We are also seeing selectively in the banking sector, in the telecom sector in Thailand, that corporates are focusing a lot more on total shareholder return. Again, very much like what we talked about in Singapore, returning of excess capital, as opposed to having that mindset that they need to grow at all costs. So a lot more focus on return on equity and a lot more focus on total shareholder returns for investors.
Yeah, I was going to get your take on some. Those are some of the winners, maybe some of the losers, right? We've obviously talked about the underperformance when it comes to Philippines. We've seen outflows in Vietnam too, which was actually last year's sort of winner. But what should I do with those markets? What are going to be some of the? I guess, is there upside potential for any of these markets in any way?
Yeah, so I think with regards to Philippines, one of the concerns that many investors will have will be with regards to the business processing outsourcing sector, which is quite an important part of employment within the country. And clearly, there is a lot of question mark with regards to how IT or AI will affect this sort of BPO processing business processing outsourcing industry and how it will affect employment. So I think Philippines is in a difficult situation as we speak now. But again, very similar to what we have shared with regards to Thailand. For investors like ourselves, we don't just invest in the macro. We try to look for unique idiosyncratic investment opportunities in Philippines. So there you have very good consumer companies that have been able to do a lot better despite the challenging economic in the Philippines. And Vietnam, if we rewind ourselves back to Liberation Day in 2025, there were a lot of concerns that they will be a big loser because they have a huge surplus with the US. And indeed, when the news first broke on Liberation Day, Vietnam stock market actually took a very large hit. And fast forward to today, I think a lot of those tariffs has been more or less watered down to a much more acceptable level. In fact, if you look at the economic growth of Vietnam, they have been doing a lot better than expected. The market actually has done fairly well in 2025. In fact, it's one of the star performers within ASEAN. I think now we would say that valuation is probably looking a bit more balanced, and hence I think we will be more tactical with regards to the kind of companies that we will want to invest in Vietnam.
Yeah, there's also that FTSE March review too. Do you think that there is potential for Vietnam to be upgraded to an EM status?
Yeah, certainly. That is the expectation, although to call the timing might be a bit challenging. But we will say that Vietnam is putting in all the right steps, and definitely going forward, we are expecting at some point in time in the next couple of years, it should be upgraded to an emerging market status from Frontier.
Pauline, great to have you. Pauline Ng, their head of ASEAN equity team at JP Morgan Asset Management, joining us out of Singapore. We've been talking to the IMF as well. Managing Director Kristalina Georgieva has downplayed the dollar's decline over the past year, saying that it should retain its preeminent position. Speaking to Bloomberg at the conference in Saudi Arabia, Georgieva also told us the U.S. currency's recent weakness could be a good thing for emerging markets.
We should not get carried away by short-term variations of the exchange rate of the dollar, and we should look closely as to why the dollar plays such an important role in the international monetary system. First, over time, we have seen the dollar going up and down. And actually, the dollar being somewhat down now is good for many emerging markets. Those that borrow in dollars now have to pay a bit less. But also what we know is that the reason the dollar plays such an important role is the depth and liquidity of capital markets in the United States, the size of the economy, the entrepreneurial spirit of the U.S. So I don't see a change in the role of the dollar in any time soon.
Okay, so you don't see that changing anytime soon. The other, I was just watching the panel now with His Excellency Mr. Jadran, and he mentioned that markets can be brutal, particularly when it comes to economy spending plans and fiscal and rebuilding fiscal buffers is another big narrative that has emerged out of this conference. Do you think that countries are taking this seriously enough, especially when, again, investors are tending to punish countries that seem to be overborrowing right now?
Well, countries better take it seriously. What has happened over the last couple of years is COVID, the war in Ukraine, they all led to government spending more to support businesses and households, rightly so, at that time. But what is the result? Fiscal buffers almost everywhere are depleted, and shocks are still to come. Therefore, what we say to everybody, to advanced economies, to emerging markets and developing economies, is now is somewhat better time. We have seen the world economy quite resilient to these shocks. Please concentrate on rebuilding these buffers. You need to have a medium-term prospect for how your fiscal position can be strengthened to withstand the shocks that inevitably will come. How are governments doing? Some better than others. And I can tell you where I'm particularly concerned is for vulnerable middle income, low income countries that are particularly stretched today. So what we want is not only for them to do the right thing, but also for the world to be mindful of these countries. We have seen development assistance going down. Well, we have a responsibility for stability and security in the world. Help these countries.
And that was IMF Managing Director Kristalina Georgieva speaking with her colleague Jumana Bersetchi in Saudi Arabia. Well, coming up, UK Prime Minister Keir Starmer shores up support from his Labour Party over a scandal tied to the Epstein files. We have more details next. This is Bloomberg.